It has been a very volatile week. These tariffs have come in way higher than even our worst case scenario. This is potentially recessionary. If these tariffs remain in place, we're talking about double-digit downsides.
Even if tariffs weren't an issue right now, there were plenty of economists that were still concerned that the inflation genie hadn't been put back in the bottle.
That is a deadly combination, right? Slowing growth and inflation ticking up. I have sensed this bearish sentiment on the rise.
The animal spirits that we all were kind of counting on to keep the stock market going and consumers going is kind of fizzled away here. We could see sentiment push us into a recession.
We have been in the process of destroying the American brand. The rest of the world's watching mistake after mistake be made.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Anne-Marie Hordern.
Live from New York City this evening. Good evening, good evening. For our audience worldwide, a special edition of Bloomberg Surveillance starts right now. Closing out the week as one Rose Garden speech upends financial markets worldwide.
This is Liberation Day. I will sign a historic executive order instituting reciprocal tariffs. China, 67%. We're going to be charging a discounted reciprocal tariff of 34%. European Union, they're very tough. We're going to charge them 20%. Taiwan, we're going to charge them 32%. Japan, we're charging them 24%. We will impose a 25% tariff on all foreign-made automobiles. We will establish a minimum baseline tariff of 10%. Promises made, promises kept.
Those words sparking a $5 trillion equity market sell-off in just 2 trading sessions. As some countries gear up to retaliate, others are hoping to negotiate.
But the fact is the countries are angry and retaliating. And, by the way, coming to the table, I got a report from the USTR last night that more than 50 countries have reached out to the president to begin a negotiation. But they're doing that because they understand that they bear a lot of the tariff.
The policy volatility leading some major downgrades across Wall Street. The Treasury Secretary, Scott Bessent, striking a defiant tone.
I see no reason that we have to price in a recession. I reject that assumption. There doesn't have to be a recession. Who knows how the market is going to react in a day, in a week. What we are looking at is building the long-term economic fundamentals for prosperity that I think the previous administration had put us on a course toward financial calamity.
And so this weekend, the White House isn't blinking, calling it an economic revolution that we will win. President Trump's message heading into a brand new trading week. His message, hang tough.
And hang tough means to the rest of Wall Street, there are probably more losses ahead because right now it is hard to understand what the potential off-ramp could be. Last week, we saw 2-day losses that were among the 5 biggest in the past century, among the 3 biggest of the past 50 years. More than 10% on the NASDAQ, on the S&P 500, as well as the Russell 2000. Stuart Kaiser said we remain very cautious. Scenarios of S&P in the mid-4,000s are not unreasonable.
Number one question on Wall Street going into a brand new trading week. Is this the beginning of a negotiation, or are these the new rules of the game? And we're still trying to answer that question following the commentary from the administration over the weekend. This is a shock to the cycle, without doubt. It takes time to fully internalize whether this is a shock to the system. That's going to take a while. The sell-off so far has been pretty orderly, Lisa. You go through those numbers, they sound huge, but so far, orderly. We're trying to figure out if the sell-off goes into a new phase, a disorderly phase, reminiscent of the pandemic, where you move into a situation where you sell what you can and not what you want.
I took a look at history when it came to the pandemic. On March 3rd, the Federal Reserve came out with a sort of circuit breaker, cutting rates outside of any kind of Fed meeting by 0.5 percentage point, the biggest cut going back to 2008. Wasn't enough. Then the markets continued to sell off, and what ended up happening was that treasuries were selling off at the same time. And so on March 15th, on a Sunday, ahead of a week where they were supposed to meet, they came out and they cut rates to 0 in order to create order. Right now, Fed Chair Jay Powell is not coming out there to be that circuit breaker. President Trump is not going out there to be that circuit breaker. It is a high-stakes game of chicken, and markets are wondering, what is the off-ramp?
It's never good when we're here on a Sunday, is it? Equities start trading in about 55 minutes' time. Coming up this hour, Mohamed, El-Erian of Queen's College, Cambridge, Libby Cantrill of Pimco on the Trump administration's next move, and Neil Dutter of Renmac on why Fed Chair Jay Powell isn't blinking. We begin this hour bracing for another big week ahead. Bloomberg's Danny Berger joins us now from the wall with your roadmap for this evening. Hey, Danny.
Hey, John. This is what the next few hours for the this market are going to look like. First, we already have FX open and running. That's been for the past couple hours. It is a story much like Friday, unlike Thursday, one of a stronger dollar. Are we finally on the other side of that dollar smile? The next stop for this market will be in an hour's time. John, this is when we get the real read on just how risk off this market might be going into Monday. At 6 p.m. local time here in New York, we'll get U.S. equity futures and oil opening. The read on oil negative so far with what's happening in Middle Eastern stocks and Saudi downgrading their price for oil. We'll also get Treasury futures and spot gold prices for a read on your havens. Some more cash assets to open in 2 hours after that. At 8 p.m., this is about approximate time here, we're going to get cash treasuries, cash Japanese government bonds too. The London Metal Exchange will also open. But the one to really look at into the open for Monday is when Chinese equities open, 9:15 p.m. ET. We will get a read on Chinese equities. Recall this market was closed for a holiday on Friday when they announced reciprocal tariffs of 34%. So it could be an ugly trade when that opens, John.
Danny, thank you. More from Danny in about 24 minutes' time. To extend the conversation, joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, welcome to the program. Good evening to you. We're all trying to figure out the answer to the same question. Is this the start of a negotiation, or are these the new rules?
Yeah, hey, good evening, John. Well, the White House officials confirmed this morning that more than 50 countries have reached out to the U.S. to negotiate. And the question is whether or not will they engage in those negotiations. A person familiar with the matter tells Bloomberg News that at the moment, President Trump is focused on the long term. And we saw that echoed in his rhetoric from over the weekend. Take a post on Truth Social yesterday, for example, where he said he claimed that businesses aren't concerned with his tariff plans because they are here to stay. We've also heard senior administration officials really double down on the claim that any exemptions or carve-outs could undermine investment when it comes to reshoring production in the U.S. White House officials are really pushing forward this idea that this is about addressing structural issues when it comes to global trade imbalances. Now, we should say that President Trump has previously indicated he would be willing to negotiate if there is a, quote, phenomenal offer on the table, in his words. It remains to be seen what would constitute a phenomenal offer and whether or not that would take into account retaliation. We should say that we're going to focus closely on those non-tariff barriers like lax IP protections, regulations, the VAT, digital services taxes that the White House kept pushing us towards when it came to April 2nd. And that's because President Trump did say that he spoke to Vietnam's leader. They offered to lower their tariff barriers to zero. And he told them, thank you, but let's keep negotiating.
Tyler, thank you. The latest from Tyler Kendall. We'll pick up on those negotiations in about 20 minutes' time when we catch up with Stephen Engel of Bloomberg out of Asia. Joining us for the hour, I'm pleased to say, a man who has seen it all. Mohamed, El-Erian of Queen's College, Cambridge. Mohamed, welcome to the programme, sir. We don't usually get to talk on a Sunday evening, and when we do, it's probably not a good thing. So let's get straight into it. Do you believe these are the start of a set of negotiations, or do you believe these are the new rules?
We don't know, John, because as much as there was uniformity when it came to statements on where we are going to end up, which is this notion of a golden age in which tariffs play a critical role in getting us there, we've heard at least 3 different messages about the short term. Message number 1 from the Secretary of Treasury, there's nothing to worry about. This rush by Wall Street and others to price in lower growth, recession. We had JPMorgan over the weekend with significant revisions. In the Secretary's view, that is excessive. There's no need to do that. So he's saying everything is fine in the short term. You have a second view that, yes, it's going to be tough in the short term, but it's worth it because these tariffs will hold. And what you're going to get is higher revenue. What you're going to get is protection. What you're going to get is people moving back to the U.S. with their production facilities. Then you had a third view expressed that you have 50-plus countries negotiating, and we may go in a world where tariffs are uniformly low across the world. So I think the hardest thing for the markets right now is not only to try to evaluate where the destination is, but how bumpy will the journey be. And I'm saying that because we have technicals playing in. Margin calls are there. People are, in fact, reducing winners and losers across the board to raise cash. Fund managers are worried about actual and expected outflows. So the thing that Lisa rightly said is there is no circuit breaker on the horizon. And the question for the marketplace is, with this confusion about what's happening in the short term, will bad technicals take over? That's the big question right now.
So, Mohamed, let's follow up on that and separate two issues. The next phase for markets and the next phase for business, corporate America, and corporations across the planet. The next phase for the markets. So far, we've repriced the cycle, repriced the economy lower. Got that, and we've done it in quite an orderly way so far. Do you see reason to believe this enters a more disorderly phase in the days to come?
It could, John. On the one hand, this sell-off has been quite indiscriminate. Correlations across asset classes have gone to 1. Whether it's equities or gold, the correlations have gone positive and high positive, and therefore value is being created in certain pockets of the market. On the other hand, people are worried about catching a falling knife. They're worried about more deleveraging. They're worried about the margin calls forcing people to raise cash. So, you've got to be really brave to go in and pick up the pockets of value, because there's still a very big cloud, a technical cloud over your head.
Who do you think is more likely to blink first? I mean, this was sort of the downdraft that we saw further on Friday, was when Fed Chair Jay Powell came out and clearly said it wasn't going to be him, because right now inflation was a serious concern. How much is that fueling this additional round of potential sell-offs that we may see?
It is, because we first priced out the Trump put. And then what we heard from Chair Powell on Friday is that the Fed put is well out of the money. And if you look at the latest revisions in inflation, JPMorgan this weekend has PC inflation at 4.4% by the end of the year, 4.4%, more than twice the Fed's inflation target. So I think, to go back to what you said, when you looked at what happened in 2020, you need a malfunctioning of markets in order for the Fed put to be back in the money. You need markets to malfunction. You need treasuries not to be the safe haven, but to start showing technical breakdown. And we haven't seen that. So unless there's a malfunctioning of market, the Fed is forcibly sidelined by the inflation side of its mandate.
In the meantime, Mohamed, companies have to take action. They don't have the luxury, as John was mentioning, of just sitting there and watching and hanging tough if they have a payroll to meet and they aren't sure exactly how much they have to charge and when they can pass along the prices. I know you sit on boards. I know you have discussions with people. I know that you are in the corporate world as much as anything else. What are you hearing in terms of how they are preparing and whether we are getting closer to that point where they have to make really hard decisions about what they keep and what they don't?
And Lisa, I listen very carefully to business leaders, because I think you get a good sense when there's a paradigm shift as to what's likely to come next. The best that you can say for the economy is that there's a set of business leaders who are willing to wait and see and take the hit on their profit margins. What hit are they taking? Higher cost and anticipation of lower revenue due to demand destruction. So there's a group that's saying, wait and see, we know it's going to impact profits, but we're willing to do that because we don't know how these tariffs are going to work out. Then there's a second group that says we can't wait. We have to take action now. So you're starting to have soft freezes on hiring. You're starting to have rounds of let's see what we can cut in terms of expenditure. And you're starting to talk about price increases, trying to pass on the higher cost to the end consumer. That second set of reaction, which makes sense at the level of each company, does not make sense for the economy as a whole. So it's going to be the balance between the two. And I must say that second set is larger from the people I talk to. Of course, it is a small sample, but it's larger than the first set.
Hey, Mohamed, great to have you with us this evening. Mohamed, El-Erian will be sticking with us. You've got to be tremendously open-minded about what happens here, quite literally. Not many people have lived through this. In fact, I'd say hardly anybody has. And the first move we're seeing from some corporations is just to pause operations. And we saw that with Jaguar Land Rover just this weekend.
How can they continue if they don't know at what rate they can potentially sell cars into the United States? You also have people pausing shipments because they don't know how they can pass this around. Howard Marks, who has been in this industry for decades, talked to us on Friday and said he has never in his career seen this level of uncertainty in terms of a potential paradigm shift that changes the rules.
Equity futures start trading in about 45 minutes' time. Up next on the programme, negotiate or retaliate.
We are prepared to respond. We're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
Up next on the programme, Libby Cantrill of Pimco, live from New York City this evening. Good evening.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because we've focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Live from New York City, under surveillance this evening, negotiate or retaliate.
We have always been ready to negotiate with the United States. At the same time, we are prepared to respond. We are already finalizing the first package of countermeasures in response to tariffs on steel. And we're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
And so here's the latest. France and Germany preparing to retaliate. Italy and Spain hoping to negotiate, as Elon Musk suggests it could end in a zero-tariff situation.
I'm hopeful, for example, with the tariffs, that at the end of the day, I hope it is agreed that both Europe and the United States should move, ideally, in my view, to a zero-tariff situation, effectively creating a free trade zone between Europe and North America. That would be that's what I hope occurs.
Joining us now for a conversation here in New York, Libby Cantrill of Pimco. Libby, good to see you.
Good to see you.
Is it fair to say we're getting mixed messages?
We're getting mixed messages maybe from Elon Musk and some of his sort of tertiary advisors. However, the folks at the White House seem incredibly committed to the idea of tariffs, keeping these tariffs on. We've talked about how the market has sort of viewed tariffs as a means to an end, a way to extract concessions from our trading partners, but more kind of bark than bite. What I think the White House is telling us, what I think that Howard Lutnick is telling us, is that this bite is sort of worth it in terms of rebalancing the economy, that tariffs are not a means to an end, or not only a means to an end, but an end to themselves. And really, as it relates to the goods trade deficit, I mean, this is something we have been talking about to our clients since 2017, when President Trump was first elected, just that he really believes that it is crucial to reduce the goods trade deficit. And I think what we've seen over the last week is he really means it.
You almost called him Peter Lutnick, which actually works, because it's Peter Navarro and Howard Lutnick.
Give the markets nightmares tonight.
Well, that's kind of what's coming out, right? Yes. So Peter Navarro coming out and criticized Elon Musk and said he doesn't know what he's talking about. He sells cars. What else does he do? But he doesn't understand some of the long-term gain that this could potentially have. You teased at something that's important, especially as we have the likes of Vietnam coming out as one of those 50 countries that are trying to negotiate. Is dropping tariffs to zero enough if it's a trade deficit that cannot be remedied with a country that doesn't have the means to meet the buying purchases in the U.S.?
I think what Peter Navarro said today was exactly right in terms of how the White House is thinking about this, is that tariff rates are one thing, but these other non-tariff trade barriers, I mean, the perception of the White House, at least, in terms of what Vietnam has been doing with its currency, what it does with its subsidies. So I think this is more complicated. And this is the thing that we're concerned about, is that there are not maybe the off-ramps that you would have thought if the reciprocal tariff rate that the U.S. is imposing on these countries was just the explicit tariff rate. Because it was so much higher, because it had to do with the trade deficit, that formula that's gotten a lot of attention, I think our view is that there are fewer off-ramps. And as a result, I mean, what we're preparing for in terms of portfolios, what we're telling our clients is that there's going to be stickiness to these tariffs. And even if there are some negotiations and some concessions along the way, I think the direction of travel here is very clear. I don't mean to be sort of a statement of the obvious here, but that tariffs are going to be high, and I think they're going to be high for a while.
That view is reinforced by the comments we've had over the weekend. We've got a mutual friend alongside us, Mohamed El-Erian. Mohamed, I know you want to jump in.
Yes, Libby, I'm quite curious because you hear in the marketplace a pushback against it's not just a means to an end, it's an end itself. And that pushback says that some combination of the following five will make it a temporary paradigm. One is markets. Two is other countries, some combination of carrots and sticks. Three is Congress. Four is President Trump's advisor. And fifth is the legal system. So those on Wall Street that believe that this is just temporary appeal to those five things. What do you think any of those are binding?
So I think that this is, again, Mohamed, wonderful way to sort of frame all of this. And I think these are all going and can all be constraints at some point. I just think that these are kind of more longer-term constraints. For instance, Congress. What we have seen so far is that absolutely is there private pushback to the White House, but for all intents and purposes, most folks are staying with the president. Now, that may very well change, particularly as we get closer to the midterms or fundraising or town halls. But I think what, again, the sort of the message that we've been sort of telling our clients is that this is, while there may be some constraints, they're not necessarily short term. And so, in the next week or weeks or months, do we think that there's going to be a significant pivot? No. And in fact, I think the White House has said that, right? They have said that in order for this to work, that these have to be durable, that there has to be some short-term pain. So I think this is, of course, there is going to be some sort of political threshold, some even sort of market constraint, but I think we're very far away from it at this point.
There's certainly another dimension to the fuller policy platform, and that's taxes. Do you believe it's sufficient just extending the tax cuts? Do they have to go even further? The fear this evening is that we end up with a negative supply shock, at least in the near term, reminiscent of, say, what we saw in the pandemic. Will that be accompanied by some form of demand-side stimulus on the fiscal side?
Yeah, and of course, maybe the upside here is that they are getting the 10-year down. rates are coming down. Of course, that is what the Treasury Secretary had said. He's been very focused. I don't mean to be flippant, but of course there is an impact and there is a benefit to having kind of shorter term, more attractive financing. So I think that if and when the economy slows, and I think our view is that absolutely have recession risks increased. For every a 1% increase in the effective tariff rate, we're sort of saying there's a 10 basis point kind of flow through, which means that if you're going to the effective tariff rate to 25%, you basically are eliminating all growth. Now, a lot has to happen in order for that to occur.
Yeah.
But I do think that just knowing how politicians work, that the inclination will be bigger tax cuts, fewer spending cuts, and more deficit issuance.
We just have a couple seconds here. I'm curious whether you give any credence to that belief that this is all designed to bring down long-term yields, to refinance at low yields. This was the subject of an op-ed on the Fox News webpage this weekend. So just 20 seconds, that look feasible?
I think I think there's a lot of execution risk. Let's just put it that way. If this is actually some grand plan, I think I would probably, I'm skeptical of that. But if it were, I think that there is a very high amount of execution risk.
Libby, diplomatic. We'd expect nothing less. It's good to see you.
Good to see you.
Thanks for dropping by. Libby Cantrill there of Pimco. Mohamed's going to stick with us. That question has been asked repeatedly, not just over the last week, but over the last month.
Let's say the yields go to 0 on the 10-year, you term out your debt. Well, there you have your budget for the Defense Department back from interest payments. You clearly have some wiggle room. Look, as Libby was saying, the execution risk is all the jobs lost in the meantime, trillions of dollars of wealth lost, and potentially stagflation, but, on the flip side, terming out debt.
Huge execution risk. Up next on the programme, Robert Koenigsberger of Gramercy Funds Management breaking down the pain across emerging markets. Live from New York. Good evening.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why. But we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The top names at the Fed are on Bloomberg.
I do know that consumer sentiment has started to take a dip. The question that we face right now is consumer sentiment going to be a leading indicator like it was pre-pandemic, or is it going to be something that doesn't really translate into actual observed behavior in the economy that is how it played out for most of the pandemic? Right now it's an open question, and it's one of the things I'm going to be watching very closely in the months to come.
Nobody covers the Fed like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
In case you missed it on the opening trade.
Is Trump, as he says he is, ready to do transformational trade deals as long as he gets his interests taken care of? Because if he is, that gives a huge opportunity for the UK to really move the dial on its growth with the US. So I can't imagine that you would shy away from that prospect if it's genuine. What remains to be seen, is it genuine on the part of the US? And we have to test that.
Don't miss the opening trade, live every weekday.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Do not adjust the TV set. This is live. It's Sunday evening. We are here. It's one of those Sunday evenings, 30 minutes away from the start of U.S. equity futures trading after President Trump's tariffs triggered the worst week for stocks since the pandemic. Bloomberg's Danny Berger joins us to tally up the damage. Hey, Danny.
John, it was a really bad 2 days for breadth. Only 14 stocks ended higher after Thursday and Friday. So it's hard to call out one individual stock responsible for the ills of this market. But if you're going to attempt to do that, it's hard not to look at Apple. This thing on its own was responsible for 1/10 of the losses of the S&P 500 on Thursday and Friday. Dan Ives of Wedbush writing over the weekend that there is no other U.S. tech stock that is more exposed to tariffs and international supply chains than Apple. He, for his part, downgraded it. Something interesting, though, happened as the sell-off got underway in those 2 days. It wasn't just the AI. It wasn't just valuation compression. Some of the more economically sensitive stocks started to join in on this. So you had energy. That performed really bad. And banks. Banks especially hurt with IPOs being paused, debt not being brought to market. You can see just how painful Friday itself was for the sector. KBW ending the 2 days down 15.8%, its worst 2 days since March of 2020. For the retailers, a little bit different and a little bit interesting. This is where you get some of the hope casting that maybe negotiations will indeed happen. So Nike, first we get the tariff announcement. It falls to its lowest level since 2017, a painful Thursday, and then it slightly rebounds as Trump says that he had a productive call with a Vietnamese leader talking about lowering tariffs to zero, but a crucial question as to whether the rally for retailers and these internationally exposed companies can continue. Is the goal lowering trade barriers, or is it bringing the trade deficit to zero? Those two things will have very different outcomes for these stocks, John.
Danny, thank you. Great work as always. Equity futures start trading at about 29 minutes time. So markets shaken as President Trump proposes major tariffs across Asia.
China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. So we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them.
China threatening to retaliate, promising a 34% tariff on all American goods as Vietnam offers to remove all tariffs on U.S. imports. The president writing on social media, quote, China played it wrong. They panicked. Joining us now, Bloomberg's Stephen Engel. Stephen, welcome to the program, sir. It's wonderful to get your perspective on things. Is China coming to the table or not?
Well, which table are you talking about? If they were coming into the ring to fight and take off the gloves and fight back, yes, they're going to be doing that. China has been fairly measured so far, and Xi Jinping essentially telling his government to remain calm until now. I think they had probably taken a little bit too many punches themselves, and finally 34%, that takes effect on all U.S. goods imported into China on April 10th, so mid this week. There are a number of different export controls. They've added some defense companies to their so-called blacklist, the entity list. They are banning chicken imports from some American companies, sorghum from one American companies. Also, again, those rare earths, further restrictions on the outflow of rare earths, which China controls a large swath of them for the tech supply chain. You know, Danny was just talking about Apple. That is a good example of how these Trump tariffs do affect American companies who, after the first trade war with China, diversified to the so-called China Plus One strategy, going, Apple in particular, making iPhones and Macs and other products in India, in Thailand, in Indonesia, Vietnam, and of course Taiwan, a huge part of the tech supply chain, all of them getting sizable tariffs from the Trump administration. So it's going to be a balancing act, obviously, for China as it tries to rebalance its economy, to boost domestic consumption, to take up its excess industrial overcapacity. You have to watch what the markets are going to do today, because the markets here in Hong Kong and in China onshore were on holiday on Friday. They didn't take the brunt like the U.S. markets did on Friday. And also you have to watch the yuan. The onshore yuan, the currency, essentially weakening to its lowest level since February. And that is one concern that they could potentially, and they haven't so far, they've kept the yuan stable, they could potentially weaponize the yuan and weaken the yuan further.
Stephen, it could be ugly. Looking forward to your coverage. Stephen Engel there out of Hong Kong as we make our way towards the Asian trading session. Lisa, Vietnam in play as well. 46% levy on the country. They have come to the table, the negotiating table.
This, to me, is the true test of what the ultimate goal is. Is it zero tariffs across the board, or is this actually renegotiating a new world order having to do with the trade deficit? Because even if you drop rates to zero on both sides, do you remedy a trade deficit? No, based on the goods the U.S. would be buying from Vietnam versus the goods that Vietnam potentially would be buying from the U.S.
Joining us now to discuss, I'm pleased to say, Robert Koenigsberger of Gramercy Funds Management, a global investment management firm focused on emerging markets. Robert, welcome to the program, sir. It's always good to get your insight on things. A lot of people are assuming that this could lead to a disinflationary shock for the rest of the world, ex-US. What does that mean for the kind of rate-sensitive economies that you cover on a daily basis?
Good afternoon, Jonathan. Thank you for having me. Look, I think the events of the last couple of days have just proven out what we've known in emerging markets for quite some time, that when developed markets get sick or get a cold, that, it's the emerging markets that end up going to the hospital. So, what we see, what the implications are, similar to what we always see in emerging markets, which is there's winners and there's losers. And it's being able to pick through those and figure out, where to invest and where not to invest. As you and I have talked about in the past, and really how to invest in the asset class.
Robert, there's a real question about the rate reaction function at a time where a Fed Chair, Jay Powell, came out on Friday and said, look, we have to be worried about our dual mandate, and inflation is a very big part of that. How much does that tie the hands of emerging markets also as they get the flu with the U.S. coughing?
Look, emerging markets, go back to COVID. Emerging markets never really had the luxury to figure out, whether inflation was going to be transitory or not. And I think that's the case today, that emerging market central banks, emerging market economies, and emerging market corporates are much more mature than they were 5, 10, 15, 20 years ago. And quite frankly, the shocks that we've had to deal with in emerging markets are less idiosyncratic. If you go back 35 years ago, and we had things like the tequila crisis and the vodka crisis and the caipirinha crisis. Now it's stuff coming from developed markets. So within emerging markets, now it's about, similar to developed markets, or what are strategies that you want to think about, what are strategies you don't. So for us, it's, okay, we think rates are going lower. We'd rather have investment grade that has duration. We think there's a higher probability of recession. We'd rather not have high yield. We'd rather be an investment grade. Quite frankly, we're not convinced that local markets or foreign currency in emerging markets is where we're going to want to be in the medium to long term. But as we've talked about in the past, I really think that investors need to quit thinking about emerging markets as yes, no, beta, no beta, and think more about beta agnostic and ways to build resilience and optionality and agility into the portfolio.
Robert, you work closely with Mohamed. I'm pleased to say Mohamed is alongside us. Mohamed El-Erian, just to come back to you and think about some of the options available to certain countries and certain companies. Can we just sit on China just for a bit longer, Mohamed? The options available to them: retaliate, devalue the currency, concede, or do they just hit fiscal? What are you expecting them to do?
And that's the big question, because the view was, as you know, John, that they have the ability to do a bazooka stimulus. They have the ability to reform in a major way their growth model, but they wanted to see what environment they're going to be operating in. Now they know what environment they're going to be operating in. It's a much tougher environment in which their growth model, which dependent on the rest of the world, is even less potent. So the hope is you're going to get not just retaliate or de-escalate vis-a-vis the US, but you're going to see China take measures that they have needed to take for a long time. And that includes being much more aggressive to deal with the property sector.
Robert, from your perspective, given that fiscal is a lever that China potentially has and has shown willingness to execute, do you see countries in the developing market that are more exposed to China are actually in a better position if they more closely align themselves with China?
Seen for quite some time, when we think about winners and losers, there was a big move of manufacturers that were manufacturing in China to places like Vietnam. And so it's been very difficult. I mentioned on the show last year that a friend who had moved all of their production from China to Vietnam. And I said, well, that must be really difficult. And he said, well, it's all the same people. And when I was in Mexico the day after the U.S. election in November, we really detected this notion that the Mexicans wanted to make sure that there weren't non-Mexican companies pretending to be Mexican, i.e. Chinese coming to Mexico to do manufacturing.
Which raises this question, Mohamed, and a lot of people have been wondering about this. Is this really going to deglobalize and create a real problem for the developing markets, or will there just be really concrete new alliances that get struck? And it's one of the reasons why people are wondering, okay, how Europe responds is going to be really important, how China responds is going to be really important, but also Vietnam and Thailand and Malaysia.
I mean, what you're going to see is fragmentation. You're going to see pipes built around the Western-dominated system. That's going to include bilateral pipes, multilateral pipes. You're going to see regionalism becoming even more important. And then when you come to the multilateralism or the globalization we've been used to, that at best is going to be managed light globalization. Managed, meaning that you will have reciprocity issues. Light, meaning no longer the ever closer integration of markets. So it's going to be this spaghetti ball that we talk about of relationships that countries have regionally and internationally. And it's something that multinationals are going to find really hard to navigate. No longer are we going to a world where you're standardizing regulation, where standards are similar across countries. You're going to have to be very specific in each of the jurisdictions you're operating in.
Lisa, Vietnam's such a great example of all of this, a case study we can all explore in the days and weeks to come. The wage differential in certain countries is so low, high relative to the United States, to move a factory and have the employers take over production right here domestically in the US. You've got to ask some big questions about how difficult it's actually going to be to move factories, even with a tariff that large.
Taking it a step further, how many companies are going to decide in the United States, look, it's worth it to pay the tariffs rather than to move the factory over here? And then, by the way, if the United States is counting on revenue from those tariffs to actually boost the overall budget at the same time that they're cutting taxes, what's the off-ramp to take off those tariffs in the future? This is the reason why tariffs tend to be very, very sticky.
So, gents, just to ask you one final question for both of you, and Robert, I'll come to you first. The rules of the game aren't clear, can change radically from one government to the next. And this time I'm not describing an emerging market, I'm describing the biggest economy on the planet. What is the lesson that you can offer people from years of navigating EM to navigate countries that are starting to take on characteristics in DM?
Look, I mean, the highest conviction theme that we've had from a top-down perspective lately has been volatility. There's been so much uncertainty going into this week. There's certainly not any less uncertainty going into next week. And volatility should be expected. Now, there was a time when people bellyached that there was no volatility and it was difficult to make market and trade markets. And we think that volatility can be your friend if you embrace it. And you can embrace it in the public markets by planning the trade and trading the plan, but also in the hybrid going to private markets where you can start thinking about getting equity-like returns for doing highly structured transactions with a lot of collateral.
Let's sit on returns, and I would say dependable returns. Mohamed, there's a generation of US-based investors that only know up and to the right. Stocks go higher. They correct, they dip, you buy that said dip. And they've benefited from the post-war system that's had the United States at the epicenter of it. Do you think that we need to rethink return assumptions, rethink equity markets in the United States if we're ready to rethink the system?
I think if you have to rethink the system, you're not just rethinking the returns, you're rethinking the volatility, as Robert just said, and you're rethinking the correlations. So you're rethinking the three basic elements that go into asset allocation. And if you do that, you're going to be pushed much more into a barbell. Over here will be your relatively safe fixed income returns. And over here will be your high conviction, name specific, well structured, as Robert said, collateralized if you can get it. And what you're going to do much less of in the middle is the blind benchmark or index buying that worked so well when everything was going up. So I think if you do remodel the global system, you're going to have to revisit returns, correlations, and volatility, and you're going to have to revisit some really basic elements of asset allocation.
Mohamed, this was great. You're going to stick with us. A special thanks to Robert Koenigsberger of Gramercy Funds Management, the latest on emerging markets. Lisa, a whole new world potentially.
That might undermine this shift to index funds for so many decades, the point where people had really counted on the ballast of many different companies, how that could get upended if this really turns into which company is actually insulated and which isn't. And we've seen some of this differentiation recently in markets.
Equity futures start trading in about 16 minutes' time. Up next on the program, the White House isn't blinking.
I see no reason that we have to price in a recession. I reject that assumption. There doesn't have to be a recession. Who knows how the market is going to react in a day, in a week.
Up next on the program, Neil Dutta of Renmac, live from New York City. You're watching Bloomberg TV.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
In case you missed it, on Bloomberg Surveillance.
I worry less about AI taking my job. I worry more about someone who uses AI really well taking my job. AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion. And so what AI will allow us to do is not just go do things that humans don't do as well, but actually do things that humans don't have the time to get done.
Don't miss Bloomberg Surveillance live every weekday.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Live from New York City, under surveillance this evening, the White House isn't blinking.
I see no reason that we have to price in a recession. I reject that assumption. There doesn't have to be a recession. Who knows how the market is going to react in a day, in a week. What we are looking at is building the long-term economic fundamentals for prosperity that I think the previous administration had put us on a course toward financial calamity.
So here's the latest this evening. The White House rejecting the idea that tariffs will cause a recession. Neil Dutter of Renmark writing, Secretary Besson just told you to not hold your breath. We are still in the escalation phase. Neil joins us now for more. Neil, good evening. Good to see you.
Good to see you guys too.
Let's get straight into that quote. What convinces you the White House doesn't blink in a week to come?
Well, I don't think they blink because that would be like complete political surrender. Right? I mean, that to me is something that's not tenable right now for the White House, in my opinion. And I also think, we were talking, I mean, Besson himself has talked about the whole notion of escalate to de-escalate. De-escalate to what? I mean, free trade? I mean, I think that's one of the reasons why the stock market's not down even more is because there's this expectation among some equity investors that, that we're going to get some kind of like free trade kind of wheeling and dealing going on here. And I just don't, I mean, Trump's heart is not in that, in my opinion. I mean, he's a mercantilist. That's what he believes. So this idea of holding out hope for some kind of great trade negotiation, I mean, what does, Vietnam, they're lowering their tariffs. So what? We'd still be running a bilateral trade deficit with them because we're a richer country. So, it's very difficult to kind of negotiate in good faith when they put out the kind of tariff rates that they did and the way they calculated them. So, you either think tariffs are a means to an end or you think the tariffs are an end in and of themselves, and I tend to think it's the latter.
Right now, pretty much every advisor on every morning show this morning came out and said the exact same thing. They're probably going to stick, but we're going to have a better future at the end. They never backed away from the tariffs or said that, yeah, we're reaching some sort of negotiation. Why do you think the markets aren't believing them?
They don't like trade. The market likes trade. It's just that simple.
What do you think happens when markets start to believe them?
Then you get the sort of financial accelerator. I mean, right, typically the market's basically a passive informant, right? The stock market, your share price of your firm doesn't tell anything about your company you don't already know. But you're getting to a point now where I think the market will take on more of a role of like an active informant, where it begins aggregating macro risk factors and outcomes, and it tells you about the future. And then the stock market does kind of take on this macro role, and that's kind of where we are. So if the stock market goes down, that creates a way of tightening financial conditions, exacerbating the uncertainty that's already out there, and you continue to have a negative feedback loop until policy gets investors to shift their attention.
Yeah, Neil, as you know, there's a famous line that markets can shape the events they anticipate, and that could be the case with financial markets over the coming days, for sure. I think we can stress test some certain theories with tariffs. We've heard a lot from the administration. Tariffs, in some respects, some regards, can work. In a situation, and I've been reading the same research you've been reading, where the level of demand is sufficiently low and the domestic capacity is sufficiently high, tariffs can work. It can support demand domestically and feed into a situation where we have the capacity available to us. When you take this approach, so broad-based like the approach we saw in the last week or so, it's difficult to imagine any other scenario apart from a negative supply shock, at least in the near term. Can you imagine a better situation?
No, I mean, tariffs are a negative supply shock. If you wanted to do some sort of targeted tariff, okay, but that's not what's going on. These are broad-based, sweeping tariffs. Sometimes against countries for which there's no domestic substitute. I mean, we can't grow coffee here or bananas here and things like that. So, yeah, I mean, I'm not at all sanguine. And as I mentioned before, I think there's a remarkable level of complacency in both sides of D.C. in terms of monetary and fiscal, frankly. I mean, Powell's going around telling us how solid the economy and the labor markets are. The rate of prime age employment rate is down 0.5 percentage point over the last 6 months. I mean, that's a very rare development outside of recession. And the San Francisco Fed reported that, I mean, if it wasn't for the weather, the jobs number would be actually quite weak. Meanwhile, at 1600 Pennsylvania Avenue, it's already working. The jobs number is a sign that things are already working. So to me, the fact that, what we know for certain is that the strike price for the White House on their put and the Fed on their put is much lower than people think. And that's even before you get into all this uncertainty around trade issues.
There's certainly no sign of Chairman Powell stepping in on Friday. Mohamed El-Erian alongside us. Mohamed, I know you want to jump in.
I do, Neil. I want to ask you a question about the U.S. versus the rest of the world. If you look at the dollar reaction initially, if you look at the yield reaction, U.S. relative to Europe, relative to Asia, it was all about the U.S. growth falling out of bed, much more than the rest of the world. But I think of the beta for the rest of the world being greater than 1. So are we seeing sequentially a process where the market reprices growth outlook for the US and then focuses on the rest of the world and reprices that? Or will the beta stay less than 1?
Well, I think what that tells me is that people are assuming that the rest of the world becomes more integrated and that we're pushing trade outside of our borders, in which case you do get this sort of capital flight story with the dollar not behaving with its normal sort of safe haven shock absorber role. That's kind of what that shows me. It's actually quite concerning, in my opinion.
Mohamed, just getting a post from Bill Ackman. I'd love your reaction to it. He says the president has an opportunity on Monday to call a timeout and have the time to execute on fixing an unfair tariff system. Alternatively, we are heading for a self-induced economic nuclear winter. Mohamed, your thoughts on that statement?
Those are strong words from Bill, especially given what he has been tweeting before. So that's quite a change in how Bill is seeing the outlook. That final paragraph and the notion of a nuclear winter, these are very strong words coming from someone who initially believed that other countries were going to come and negotiate.
Got a smile from Neil.
Well, yeah, I mean, I think it's, look, to me, I think it's foundational, honestly. I really do. I think this is like a foundational thing. I mean, someone should go into the White House and play the video of Milton Friedman talking about the pencil and capitalism and freedom from the 1980s. Because we all, I mean, he was talking at that ceremony on Obliteration Day. He was talking about, you know, how, you know, there was this young, strapping-looking man, you know, talking to Oprah about, you know, when he took out that ad in the paper about, you know, how we're getting ripped off. Remember, at the time, that was coming off the Plaza Accord. We had a massive decline in the dollar. The trade deficit was, in fact, narrowing, and he was still talking about trade deficits and how we're getting ripped off. So, I just think it's foundational. This is what he believes. If you think that he's some like great free trade advocate, I don't know. I mean, I think he believes in mercantilism. That's what this is, and you know, I mean, so you know, proceed accordingly.
Mohamed, I've got 20 seconds left. Equity futures start trading in just a moment. Any reason to believe that things stabilize from here anytime soon?
Not after what I heard in the last 55 minutes, John. If what we've heard on this show is reflective of the general mood, then we have some pretty tough times ahead of us.
Mohamed, appreciate your time. As always, Mohamed El-Erian of Queen's College, Cambridge. A special thanks to Neil Dutcher of Renmac. Coming up on the programme in the second hour, Bob Michael of JPMorgan Asset Management, Cameron Dawson of New Edge Wealth, Nouriel Roubini of Roubini Macro Associates, and a whole lot more. Live from New York, this is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I never heard.
We'll do it for fun.
Ready? Go.
In case you missed it, on Bloomberg Open Interest.
Finding some sense in these crazy markets.
I hope they turn around, though. You know, because my 401k, I'm looking at my 401, my retirement, and I'm thinking, God, how many more decades do I have to work?
Your retirement account. I cannot say that enough. Set it and forget it.
You need to find a new target date.
I need to find maybe a new future. I'll be standing next to Paul Sweeney as a greeter at Walmart, you know, in our 70s.
Don't miss Open Interest live weekdays.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
In case you missed it, on The Pulse.
You know, it's not the headline-grabbing $15 billion bankruptcy. It's not Lehman Brothers. It's not that. But what is happening underneath the surface is just frantic activity. There's a moment in time when real estate gets really interesting.
Now or soon?
Now. It's here.
Don't miss The Pulse, live every weekday.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Wednesday's announcement was a seismic shock to the market. It is yet to see the aftershock in the economy.
This was bigger than we expected, right? And I think it was essentially bigger than everybody expected.
If these tariffs stay, all bets off, because it changes the whole paradigm.
Inflation's going to tick up notably higher on the back of all these tariffs.
In the interim, it doesn't feel transitory.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Anne-Marie Hordern.
Live from New York City this evening, the second hour of a special edition of Bloomberg Surveillance starts right now. Heading into a brand new trading week, whipsawed by policy volatility, a major tariff push, sending the S&P 500 to its worst week since the pandemic. And the Nasdaq 100 plunging into a bear market. The president isn't blinking, and Chair Powell isn't racing to step in, stressing the need to keep inflation expectations well anchored, leaving strategists across Wall Street cutting price targets, and JPMorgan now forecasting a recession. Mike Ferro writing, the forecasted contraction in economic activity is expected to depress hiring and over time to lift the unemployment rate to 5.3%. This year's bear case very quickly becoming the base case.
Which is the reason why Wall Street analyst after Wall Street analyst has come out and downgraded their expectations for the S&P 500 time and time again. Lori Calvasina put out a note today, actually, of RBC Capital. She'll be joining us tomorrow, where she said the conversation increasingly is shifting from stagflation to recession at a time when people are taking a look at where the off-ramp is. Right now, it is not coming from President Trump, and it is not coming from Fed Chair Jay Powell.
Evercore's Julian Emmanuel cutting his price target on the S&P 500. Tariffs and turmoil. Down from 6,800 to 5,600. 5,600 a few months ago sounded very bearish. Now it sounds bullish, in light of what we've seen over the previous two sessions.
Especially when you have the likes of Stuart Kaiser from Citigroup saying it wouldn't surprise him to see something in the mid-4,000s, that this doesn't feel like there is a circuit breaker. We also talk about what Lori Calvasina is projecting. If it's stagflation, she's talking 4,900. If you're talking recession, the drawdown has been, going back to the 1930s, something between 27% and 32%, which would take it down to 4,200 potentially at the low end. So some pretty bold statements at a time of a growing question mark. What is the end game here?
If you're looking for stability, we're not getting it. Equity futures down and down hard at the open. We're negative by close to 5% on the S&P 500. Coming up this hour, we'll catch up with Bob Michele of JPMorgan Asset Management on the Fed's next move. We'll speak to Cameron Dawson of New Edge Wealth, looking for a potential bounce, and Nouriel Roubini of Roubini Macro Associates, expecting more market pain. And Danny Berger, more market pain is exactly what we're getting.
That's right, John. We have our first read of some of these risk markets this morning with the future trade underway. It is a clear risk off and uncertainty and fears of recession, perhaps, with S&P 500 futures down more than 5%. Brent crude down more than 2.5%, with the Saudis cutting their price of oil. That's also another recessionary fear of energy is trading off. We also have a read on FX that's been trading for the past few hours. We are at the lows of the evening when it comes to the dollar versus the yen. There is a clear bid into havens. That extends to Treasury futures too. Now, as to where the roadmap goes for this market, we have these assets open, but in about 2 hours time, we're going to get more liquidity injected into the market trade. We're going to get cash treasuries. They will begin to trade around or so 8 p.m. Eastern. Japanese government bonds, those will also trade along with the London Metals Exchange. Now, the last stop before we really get underway with the Monday trade, the one to look out for is 9:15 p.m. Eastern. That is when Chinese equity markets will open. The reason, John, that this is going to be interesting is that China was closed on Friday when they announced those reciprocal tariffs of 34%. So 9:15, that is the first time we will get a look into how we react in Chinese equities.
Danny, thank you. More from Danny in about 26 minutes' time. Let's just take a beat. The size and scope of these moves, reminiscent of .com, GFC, the pandemic. We're down by 4%. We dropped by almost 10% in just 2 trading sessions. Stateside wiping out more than $5 trillion in market cap in just 2 trading days. Tyler Kendall joins us now from the nation's capital for more. Tyler, just to come to you, equity futures down another 4 percentage points. Any sign whatsoever that the administration is blinking this weekend?
Yeah, hey, John, at this point, no. The White House is holding firm. A source familiar telling Bloomberg News that at this point, President Trump is focused on the long term. That then begs the question, what will it take for the U.S. to negotiate? And there's a few mitigating factors here, as obviously you're covering, and we've spoken about multiple times. It appears this White House does have a pretty high tolerance when it comes to the equity markets, though they do say they have their eyes on yields. Instead, White House officials keep pointing us to the fact that they think that this is about a long-term growth agenda, that they want to address those structural issues when it comes to trade imbalances, even amid the sizable stagflation and downside risks. We should say the White House did confirm this morning that 50 countries have so far reached out to negotiate with the U.S. Now, President Trump says that he needs to see something phenomenal in order to engage in those negotiations. It remains to be seen what phenomenal would be, although it does appear that it might take a little bit more than just lowering trade barriers, as this administration says that it's really focusing on trade imbalances and deficits. John, we could get a firmer idea tomorrow. Israeli Prime Minister Benjamin Netanyahu will become the first foreign leader to come face-to-face with President Trump since the tariff announcement. As you well know, Israel lowered its tariff barriers ahead of April 2nd to try to get ahead of it, but we're still slapped with a 17% levy.
Tyler Kendall down in Washington, D.C. If you are just joining us, just moments ago, equity futures started trading. We had a 10% move in 2 days. We're down another 5% on the S&P 500. On the NASDAQ, down by 5.2. On the Russell, we're down by 6 full percentage points. Bob Michele, the global head of fixed income at JPMorgan Asset Management, writing this. Both the administration and Federal Reserve are behaving as though the market moves are business as usual. We cannot believe that the Fed will wait until something breaks before responding. Bob joins us now for more. Bob, good evening.
Happy to be here.
GFC.com, the pandemic. Frame this moment. What is this for you and the team?
Well, I was reading Larry Summers earlier, who pointed out that Thursday and Friday were back-to-back the worst market drops, except in 3 other instances. The 87 stock market crash, 2008, the financial crisis, and then 2020, COVID. So this is a historic period, and as you point out, we're down another 5%. I would tell you, in the other 3 instances, the Fed stepped in immediately and cut rates sizably. So I think for now, if you go back to Friday, the Fed can talk tough. They have to be looking at this. I don't know if they can even make it to the May meeting before they start bringing rates down.
At the same time, nothing seems to have broken yet. It doesn't seem like things have gotten disorderly yet, despite the margin calls. And there is a real concern about inflation picking back up. How much can you really reject what Jay Powell said on Friday?
Well, you have to reject something he said over the last few years. Remember, they talked about the long and variable lags. So now they're saying they're going to wait for the accident before they respond and then wait for the long and variable lags to take hold. I don't think so. I think if you step back and look at the totality of what's going on, you cannot believe that there's nothing under the surface that's going to break. We already know that businesses in the lower rated end of the quality spectrum have been struggling. When you look at private credit and look at the percentage of amend and extends, it's very high. What happens when their cost of funding just ratcheted up another couple percent and they're going to see top line growth come down, as well well as their input costs go up. I think this is a serious moment. I do not think the Fed can just sit on the sidelines.
If you do believe that there is going to be some kind of policy response, does that mean that you are coming in when you saw about a percentage point increase in 2 days in the spreads, in credit and high yield credit? You see that kind of, move that's the biggest going back to 2020. Can you buy it? Or do you say until you see the whites of some kind of policy response's eyes, you can't get involved?
I'm not that courageous with my clients' money. I'll tell you that much.
I don't think so,
I see what's going on, and you just simply model and you go, hey, credit spreads went from 260 to 440. Maybe 500 to 800 over is the correct place for them to settle. 800 if we're in recession, low 500s if this keeps going for another week. So I think there's more of a washout yet to come.
Bob, so far this has been orderly. People will use that word, orderly. Have you seen any sign that things are set to become disorderly? Lisa and I were thinking about the days and depths of the pandemic. There were certain days where risk gapped lower and bond yields actually rose on Treasury yields. And that was a situation that a lot of people just described as selling what you can and not what you want. Are we going to move into that phase of the sell-off in the coming days?
Orderly is such a wonderful word for complacency, isn't it? And when I think about what's been going on, there's been some widespread acceptance of this. When we've talked to clients, and we've talked to a whole range of clients, most expected something like this could happen on the tariff side, but hoped it wouldn't. And now it's unfolding, and now they're a bit frozen. Unless we see some sort of policy response from the administration, from Congress, from the Fed, I think this washout has more to go.
How do you value a company, any asset, without knowing the rules of the game? And I think that's what's really, really difficult about this moment. Lisa, when you see economic data, payrolls, downside surprise, unemployment starts to climb, GDP's bad, whatever it might be, I think you can reprice the cycle rather effectively off the back of that. Maybe not all at once in the right way. Maybe you overshoot in one direction or the other. But when you don't know the rules of the game, it's very difficult to value an asset.
Predictability is what companies rely on to actually get their businesses and have longer-term plans. You look at this type of scenario and you wonder, how do they begin to understand what they can import from, how they can export? And then you start thinking about the market reaction. How does an investor start to price any of this in, which is the reason why people think that it's now the uncertainty, but also the fact that this isn't going away anytime soon.
We've talked a lot about equities, and if you are just joining us, welcome. Equity futures started trading about 11 minutes ago, and we're down 3.6% again this evening. Just to describe what's been happening in high yield, Lisa touched on it. We've seen high yield spreads gap wider by 100 basis points in just 2 days, Thursday and Friday. But Bob, if you look at the level, 427, historically, 427 is actually pretty tight. What are you thinking about in terms of spread levels in the weeks to come?
427 is reasonable. I wouldn't call that tight. In retrospect, 260 over looks tight.
That's very tight.
So I think it's reasonable for a normal, steady-state economy. I think if you're heading into any kind of slowdown, you want to see the cost of funding to below investment-grade companies push up towards 10%. That's another 150 basis points or so.
Lisa, are we seeing any signs of distress across fixed income?
Well, I mean, honestly, the spread blowout and the magnitude of it is the greatest going back to March of 2020. You take a look at credit risk across the globe, you're seeing this similarly, particularly with high yields. The real question becomes, longer term, how do investors plan? Bob Michele might see a trigger from the other side, but he's not buying anytime soon. So it raises this question. At what point do you start looking at where the weakest companies are and start planning for a default cycle, given the fact that right now that seems to be a suggestion that's getting priced in?
But the administration has told us you can now analyze everything. Last week you criticized me, 2 weeks ago you didn't have the details. Well, here are the details. You saw
So do you believe them? Do you believe these are the new rules of the game?
I believe that a 10% baseline tariff is here to stay. I don't know. I was in Australia a couple months ago. They were all saying, well, you know what, we don't have any real tariffs on the U.S. We'll escape. They've got a 10% tariff. So I think there's going to be some minimum baseline assessment, and I think the administration's playing for the long run here.
If the rules of the game have changed, does it make U.S. assets less attractive on a relative basis?
I think it does. I think you're going to look at non-U.S. economies investing in themselves. We already saw some of that come out of Germany in the last couple of weeks. we expect to see more out of the EU. Certainly, that could be a policy response in China. They did it after the financial crisis. They'll borrow and spend, create more of a domestic economy.
Bob, you're going to stick with us, I'm pleased to say. Bob Michael there of JPMorgan Asset Management. Welcome to the programme to you all and good evening. Equity futures opening up lower by 3.7%. Up next on the programme, the bulls throw and give the towel.
This is potentially recessionary if these tariffs remain in place.
I've sensed this bearish sentiment on the rise.
The rest of the world's watching mistake after mistake be made.
Up next on the programme, Cameron Dawson of New Edge Wealth, live from New York City this evening. Good evening.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Live from New York City this evening, good evening to you all. Equity futures trading, and they're trading lower. We're down and down hard. We're negative by 4% on the S&P. On the Nasdaq, we're down by 4.3. On the Russell, Lisa, we're down by more than 5.
No one is looking to catch a falling knife, and that seems to be what we're doing this evening with no blinking across the board. Remember that Scott Bessent told NBC's Meet the Press, I see no reason that we have to price in a recession, and said that the market carnage is a short-term reaction by organic animals. This isn't a blink necessarily by the administration.
The White House isn't blinking. Under surveillance this evening, the bulls are throwing in the towel.
This is potentially recessionary if these tariffs remain in place.
Even if tariffs weren't an issue right now, there were plenty of economists that were still concerned that the inflation genie hadn't been put back in the bottle.
I've sensed this bearish sentiment on the rise.
The animal spirits that we all were kind of counting on to keep the stock market going and consumers going is kind of fizzled away.
We have been in the process of destroying the American brand. The rest of the world's watching mistake after mistake be made.
So here's the latest this evening. Strategists racing to revise their outlooks as RBC's Lori Calvasina says her bear case is now her base case. Cameron Dawson of New Edge Wealth writing, we are likely to reach oversold flush levels. That could set up for a bounce, but we think trends have deteriorated significantly, suggesting that the bounce could be short-lived. Cameron joins us now for more. Cameron, good evening.
Good evening.
You expecting a bounce now?
Well, certainly not this afternoon or tomorrow morning. We have seen enough of a flush within markets that usual technicals would suggest that you could see a little bit of a relief rally, but we have to acknowledge that if you are completely imploding the last 40 years of economic world order over the course of these tariffs, that maybe some of the past rules don't apply. But we have to stick to the numbers and not the emotion. And the numbers do suggest that you have seen some flush signals, which probably get even more extreme after Monday's trading.
At the same time, over the weekend, a lot of calls back and forth from different executive questions about margin calls. We've been discussing that and whether there's anything in the dollar being sold, gold being sold, crypto assets being sold that's suggestive of forced selling. Are you seeing any signs of that?
There certainly seems to be at least a little bit of an uptick in disorder, because what you can see is when correlations rise between stocks on big down days, you see things like the number of names hitting new 20-day lows hit over 76% on Friday. You had the number of names above their 50-day moving average at just 12%, put call ratio at 1.3 intraday. That all suggests this idea of people are selling indiscriminately, which suggests that idea of people are selling what they can in order to offset some of the big losses that they have in other parts of their portfolio.
Let's say people model out what we heard from the tariff regime that was put out in the Rose Garden last week. What are we pricing in? What's the ultimate end game? If that goes into effect, is it recession? Is it stagflation? Does it matter? Have people thought about that?
We closed on Friday trading at 19 times forward earnings on a $270 a share number that implies 11% growth for 2025. That's not a recession in the EPS number, and that's not a recession in the valuation as well, which is why we think that this volatility continues, even if you see that short-term bounce from a technical perspective.
We're going into earnings season. We're here from Delta Airlines this coming Wednesday. You're here from the big banks reporting on Friday. But when you think about what you're looking for from corporations, what are you looking for in the weeks to come this earnings season? What are you expecting them to say? What can they say?
Well, I'm expecting them to tell us what they plan to do with CapEx and hiring, because they do know where the tariffs are. They do know the size. They can't sit there and meet with analysts and say, we have no idea. They have to be doing something. What is it?
That interplay between margins and consumer price tolerance, what is that interplay going to look like in the weeks to come when they have to set a price to account for a new tariff, a much bigger tariff potentially as well in the coming days?
If companies are able to pass on price increases to customers, it actually can be good for margins. That's what happened in 2020 and 2021. But we don't expect that to happen this time around, because the purchasing power of consumers' ability to absorb higher prices is much less than it was in a time like 2020 or 2021, when you were giving consumers checks to fund that spending. So we think a lot more of this pain from higher prices will have to be absorbed in corporate margins. The end result of that is that companies will look for other places to reduce costs. They'll start pulling back on CapEx, potentially start pulling back on hiring, turning to firing in order to defend margins. And that's the risk to economic growth.
Have you been encouraged by the fact that Treasuries, Cameron, have been something of a haven?
It certainly is supportive of the idea that you're not going to see this really terrible scenario of the back end of the curve really backing up because of deficit fears and funding of deficit fears. We think that's the worst case scenario in all of this, is that if you see the short end of the curve come down and the expectation that the Fed is going to cut rates, but the back end stays sticky, that means that you don't get the boost from things like mortgage refinancing, and you have continued pressure on corporate funding costs. So that's what we're watching in the interplay with the curve, and that suggestion that are we in an environment where people have less demand for treasuries because of the deficit? At least over the last 2 days, that hasn't happened. But look at the intraday reversal on Friday of the 10-year. That caught our eye.
Well, but Bob, to this point, this administration, when asked about how much they care about markets, they've always come back to the 10-year. They never talk about the S&P 500. The put has always been in the bond market. At what point do you think the White House welcomes this if 10-year yields keep going lower?
So, Cameron, Friday's reversal has just reversed again.
Oh, good.
I'm looking at 10-year Treasury reversal. You know, the 10-year Treasury futures yields are down about 10 or so basis points. I think the focus on the 10-year is very clever, because they know that's where the average American's mortgage is set off of. So try to push that down. That's probably where they would like to drive a lot of the Treasury borrowing, further out the curve and away from the front end, where it was planted. So they need to do some of that. And then they also know that businesses tend to do a lot of funding out across the curve. So try to bring that down, benefit businesses and households, and of course themselves and government.
It's too cute. Execution risk is too high. Sure, yields might drop for all the wrong reasons. What do you think is going to happen to tax revenue? If yields are dropping because we're all repricing the economy and pricing in a recession, maybe we avoid it. I hope we do. What do you think happens to tax revenue?
I was just saying, having this conversation over the weekend, you got to look at both sides of the balance sheet. Tax revenue falls off a cliff at the same time that, okay, borrowing costs are a lot lower. Does that really get to the ultimate goal of balancing the fiscal health of this country?
You need the growth. We've been running 6% budget deficits with unemployment down at 4%. What does everyone think is going to happen to the budget deficit if we enter a recession?
I guess that this is the question that people have to ultimately ask. Do you believe that this was a deliberate act to try to bring 10-year yields down? I mean, do you believe that, Bob Michael?
No, I don't think you crash the entire U.S. and global economy just because you want 10-year yields a little bit lower. Do I think that the administration has said, here's our tariff policy. Now, Congress, ball's in your court. Here's the Tax Cut and Jobs Act extension plus everything I want to hang off of it. You going to pass it or not? And Fed, hey, you can cut rates. You've cut them before. So conveniently, the ball has been passed from the administration to the Fed and to Congress. Will they take the pass or not? Right now, certainly the Fed looks to be fumbling the pass.
I'm pleased you went in that direction because I think it's a great point. The next stop for this conversation is the tax bill. And Cameron, for a lot of people that came into the new year, bullish this administration, pro-risk, pro-growth. It was the more complete policy platform. Not trade, but taxes. What are you expecting now?
Well, there's a big contingent within the Republican Party that does not want to count tariffs in order to give tax cuts in other places, meaning that they are not comfortable with extrapolating tariff revenue in order to balance the budget. So the big question is, will you really get the tax cuts to offset what is a tax hike with these tariffs? And we're not so certain, which just means that maybe you get the extension of the baseline, but we're not positive that you're going to see this big offset with much lower corporate taxes or lower taxes on consumers, which just means that we get a lot of the pain from the tariffs, not necessarily the offset from lower taxes other places.
Cameron, this was great. Almost said good morning to you when you walked in. Yeah. It's an odd feeling, isn't it? Cameron Dawson of New Edge Wealth. The latest moves look like this. We're down 4% on the S&P. The Nasdaq down by 4.75. Check out these moves in crude. Down another 3%. It's a break of 60 on WTI, 59.93. On Brent crude, we're at 63.53. Up next on the program, Nouriel Roubini expecting more market pain before Trump starts to de-escalate. That's his call. He joins us next.
The top names in business are on Bloomberg.
Is an IPO possible now for you for Ripple?
Well, it's certainly something that is possible. The United States SEC under Gensler was so hostile to this industry. I mean, ironically, they approved the S1 from Coinbase and then sued them for doing the things they said they were doing. So this SEC, fortunately, is going to be, I think, very constructive and positive for this industry. That being said, it isn't a huge priority. I think most companies are going public. Raising capital is something that is high on their radar. We have been in a very fortunate position to be able to grow the business organically. We're also, frankly, more proactive in looking at acquisitions. This is an industry that finally is going to be able to thrive in the United States, the largest economy in the world. And I think the industry is still underestimating the shift from the headwinds to the tailwinds. That's going to make a bigger difference than people think. And finally, the U.S. market is really unlocked.
Nobody covers business like Bloomberg. Context changes everything. The top names at the Fed are on Bloomberg.
I do know that consumer sentiment has started to take a dip. The question that we face right now is consumer sentiment going to be a leading indicator like it was pre-pandemic, or is it going to be something that doesn't really translate into actual observed behavior in the economy that is how it played out for most of the pandemic? Right now it's an open question, and it's one of the things I'm going to be watching very closely in the months to come.
Nobody covers the Fed like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
In case you missed it on the opening trade.
Is Trump, as he says he is, ready to do transformational trade deals as long as he gets his interests taken care of? Because if he is, that gives a huge opportunity for the UK to really move the dial on its growth with the US. So I can't imagine that you would shy away from that prospect if it's genuine. What remains to be seen, is it genuine on the part of the US? And we have to test that.
Don't miss the opening trade, live every weekday.
In case you missed it on Bloomberg Surveillance.
I worry less about AI taking my job. I worry more about someone who uses AI really well taking my job. AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion. And so what AI will allow us to do is not just go do things that humans don't do as well, but actually do things that humans don't have the time to get done.
Don't miss Bloomberg Surveillance live every weekday.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Thursday, Friday, two-day loss, 10.5% on the S&P. Here's day three. Equity futures down across the board. We're negative by 3.8% on the S&P 500, down almost 5% on the Nasdaq 100. At the wall with more. Here's Danny Berger. Hey, Danny.
Hey, John. Maybe the good news is that the overnight limit for circuit breakers is 7%. We're not too far from that now, but at least there is a mechanism to step in if it gets worse. But this is the bad news. As you point out, it adds to an already really ugly Thursday and Friday. Just take a look at what Apple did over those 2 days, down some 16%. This in itself contributed to 1/10 of the losses in the S&P 500 over that time period. Dan Ives of Wedbush saying that Apple is the single most exposed stock to U.S. tariffs when it comes to tech. He downgraded it, putting out that 90% of iPhones are made and assembled in China. Now, it's not just tech, it's not just AI. That was the beginning of some of the correction, right? The beginning of some of the pain was that valuation come down. Banks started to join in to that at the end of Thursday and Friday. You can look, this is just the action on Friday, but overall banks in the past 2 days fell 15.8%. It is fears about the economy, and it's also an IPO and an M&A market that became frozen. Now, finally, the retailers had a really interesting 2 sessions because, as you'd expect on Thursday, they get hit and they get hit hard. Nike really encapsulates this. At the end of the trading day, it was at the lowest since 2017, but it starts to rebound as Trump talks about this idea that he's had a call with the Vietnamese leader and they're going to take trade and they're going to take tariffs down to 0. But the question you have to ask as to whether this thing can come back and rebound is, what is the goal? Is it to lower trade barriers with American partners, or is it to get the trade deficit to 0? And those two will have very different outcomes for companies like Nike, John.
Danny, thank you. Great work. Tremendous damage done to the market, said to continue. If you're looking at equity futures right now this evening, we're down by 4%. The move low we've seen in crude has been absolutely huge, and we're breaking 60 on WTI this evening. Lisa, if you think about Thursday was the shock following the April 2nd announcement. Just the shock, just the policy volatility, just the unexpected nature of how broad-based and large it was. Friday, we started to really think about, my goodness, how do we internalize the shock to the system, not just the shock to the cycle? You certainly think that today and this evening is that, plus the fact that over this weekend we have seen no sign whatsoever that the administration would blink, and no sign from Chairman Powell going into the weekend that he's going to step in either.
And no answer from any of those officials who went all on the morning shows, the weekend shows this morning. No answer to whether tariffs were an end goal or a tool to bring down the rate. That was never answered in one of those interviews, except that tariffs will be here to stay and the direction of travel is clear.
So here's your calendar for the week ahead. It shapes up as follows on the trade side. 10% baseline tariffs are already active. Reciprocal tariffs are set to kick in on April 9th. China's set to retaliate on April 10th. The very same day, we get US inflation data. Mike McKee joins us now for more. Good evening, Mike. That's quite a week still to come.
Yeah, but the economic data is going to stay out of it for a while. We don't get CPI until Thursday. We get PPI on Friday. And both of those data points are going to reflect March data rather than anything that's happened since the tariffs were put on. We could see a little bit of evidence that it's going to happen. You look at PPI, and the year-over-year rates are expected to go higher. CPI expected, for the most part, to be in line and a little bit lower. But what is it that we're looking for? Well, there were a lot of things in the imports that we got in January and February that suggest maybe prices start to rise for a few things. And where are we going to see all this first? Fruits and vegetables, coffee, things that we don't make here in the United States, they could have gone up. Toys were a big import. Wine and beer, now that aluminum cans are sanctioned. And then in the PPI, it was finished metals and industrial supplies, electronics. Those were brought into the country in big numbers in the last 2 months. So it is possible rates went up on those. So we'll see if there's any kind of a hint at what's coming. But for the most part, all of the things that Wall Street fears about inflation are still down the road.
Mike McKee, thank you, sir. Let's extend the conversation with Nouriel Roubini, the CEO of Roubini Macro Associates, weighing in on the president's next move, saying, quote, if he's rational, he's going to de-escalate. Nouriel joins us now for more. Nouriel, thanks for staying up late for us into the evening, sir. It's great to catch up with you. You're describing this as a three-way game of chicken. Just frame that for all of us.
Well, it's a game of chicken between Trump on one side, Powell at the Fed on the other, and Xi Jinping on who's going to be blinking first. You know, Trump is trying to nudge Powell to blink and his monetary policy as a way to push markets higher. But Powell knows that given what happened on April 2nd, if he blinks, there'll be a de-anchoring of inflation expectation, and those stars are going to lead to higher inflation. So he's not going to blink. Of course, there is a Powell put, there is a Trump put. But Powell, I don't think he cares as much about the stock market. He cares about high yields. Because if high yield spreads were to widen a lot, that's a true sign we're going to go into a recession. This past week, high yield spreads have gone up only 100 basis points. That's not yet a distressed point of view. The point about the Trump put that he doesn't care anymore about the stock market, and he believes that actually long rates have gone lower, the dollar is even a bit lower, maybe that's an easing of financial condition, so he doesn't want to blink. And when it comes to Xi Jinping, there's the beginning of this game of chicken between Trump and Xi Jinping. We started with attacking them, they retaliated, we may retaliate, they're going to retaliate. That's going to lead to a full-scale trade war. I think that Xi Jinping has more leverage. He doesn't face an election next year. Yeah. He can use monetary policy, fiscal policy, and currency policy, and structural policy to strengthen domestic demand. And he's not going to give a Xi put a signal he's going to start to negotiate until Trump is really serious about de-escalating. But it looks like Trump doesn't want to de-escalate with China because he wants to corner China and to lead to a radical reduction of the trade imbalance between U.S. and China. Now, in this game of chicken, I think that we end up actually that the rational thing to do for Trump will be to de-escalate, because if he doesn't, there is for sure a recession. If there is a recession, he loses the midterms, and then he's politically gone. But I think that he might not blink because, one, he may think that it's not going to be a recession, or he might think that if there is a recession, then he can blame it on China, and the people in the Rust Belt are going to support him in his goal of reshoring manufacturing. I think it's delusional. But the probability of really collision course is really rising, and the probability of a U.S. and global recession is rising and becomes a baseline unless Trump blinks and de-escalates.
Hold on a
we
second.
don't know when that's going to happen.
Nouriel, I just want to jump in here. There's a real question over the weekend. We heard from a number of different cabinet members of President Trump. After hearing all of what they said, are you more or less optimistic that there will be some sort of start of negotiations in the next few weeks?
I think there will be negotiations with trading partners that do not matter. You can do a deal with Vietnam. You can do a deal with Michele in Argentina, with Israel. You may even try to negotiate something with the Europeans, but that's going to be tough because they may start to retaliate. The big thing that can help the market is if there is a call between Xi Jinping and Trump, and they say, we're going to postpone these tariffs on both sides by 90 days, and let's try to have a grand bargain. I don't think there is any evidence that that call is going to occur and that negotiation is going to start. If anything, I think there is a risk of escalation on both sides because both of them essentially feel that the other side is having some malicious intent. And therefore, I worry that collision course is going to continue. The market is going to keep on going lower and lower. So that's the key thing. Is there a negotiation with China? The rest is not really spare change.
Nouriel, you're usually pretty good during these crises for identifying where there are fractures in the system that could break. What looks to you like it could break if things don't de-escalate?
Well, first of all, you have the direct effects of very high tariffs. If you take an economic model, those level of tariffs of April 2nd at full scale lead to a U.S. recession and to a global recession through a variety of trade links. But then you have a significant impact on consumer confidence. You have a significant impact on business confidence. You have some wealth effect coming from the stock market. Bond yields have gone down, but during the past week, high yield spreads have gone up by 100 basis points. So any fall in bond yields has been undone by the rise in those spreads, and they're beginning to creep higher. And in the past, the Fed, like in 2018-19, blinked when there was a real massive spike in high yield spreads. And if things continue this direction, high yield spreads are going to go even higher. And that's a breaking point because what matters is not as much in the short run the stock market, but credit spreads, because those affect the cost of capital for the economy. So they're all getting excited about the fact that bond yields are lower, but high yield spreads are much higher. They're going to go much higher. And that can, among other things, kill the economy.
Nouriel, let's just sit on this theme because I think it's a really, really important one. We haven't had a large default cycle for quite a while. Through the pandemic, we avoided that because we had huge fiscal transfers. Where do you think the leverage is now? When you think about where there might be pockets of leverage, it's a question we always have to ask going into a downturn and sudden stops like the one we might see in international trade. Where do you think the leverage is at the moment?
Well, the leverage is especially in the weaker part of the corporate sector, that is those firms that are essentially high yield, especially the worst part of the high yield, if you go at the C level, or even among $1 trillion of fallen angels have gone from investment grade to below investment grade. That is the leverage. And that leverage has been financed a lot by the shadow banking system, not the traditional banks. So we didn't see it in the balance sheets of the banks. So far, credit spreads have been very, very low, not just for high grade, but also for high yield, because the economy was growing. The balance sheets of these corporates were poor. But if the economy is growing and you have revenues and you have some earnings growth, you can manage. You're not going to have a default. But now, in addition to a balance sheet problem, you also have a P&L problem, that if there is going to be a recession, of course, the revenues and the profits of these firms that are already weak are going to hit. And that's where the credit spreads can widen. But when they widen, they often widen excessively, not only for high yield, but also for high grade. And in a recession, even the high grades are going to be, to some extent, a greater risk. So really, credit markets are key at this point because we have a huge amount of leverage in the corporate sector. with balance sheets that were excessive leverage, but P&Ls were doing well. When you have a shock to P&L, you have a bad balance sheet, then you have a credit crisis, and the recession becomes very severe. Could be as severe as 2008.
Nouriel, does the same logic apply when you say things like that, particularly going back to a year like that one? Does the same logic apply to developed market sovereign balance sheets?
Well, it depends. In the case of the United States, for now, bond yields have gone lower in spite of actually this tariff being inflationary. One, because there is a risk of a recession. Two, because if there is a recession, the Fed may cut rates. And three, the Fed had told us, given what they've decided on April 2nd, we may not blink, and therefore there is not a de-anchoring of inflation expectation. However, if Trump and Powell go on a collision course, each one of them waiting out for their own strike price on their put to be exercised, then could be tensions. And those tensions might lead either to the Fed to blink, but if they blink in a time where inflation is going to rise because of the tariff, inflation expectation get de-anchored and bond yields go higher, or hopefully is Trump that is blinking and you have de-escalation.
Nouriel, it's wonderful to get your opinion on things, sir. I know you're travelling at the moment, so I appreciate you staying up late to share them with us. Thank you, sir. Nouriel Roubini of Roubini Macro Associates sharing his thoughts on the situation. Lisa, in very simple terms, developed market debt. The rules go like this. When things get bad, people buy it. EM debt. The rules are something like this. When things get bad, people sell it. Do you think there could be a situation here, given how the transfer of leverage that we saw through the pandemic went towards the sovereign balance sheet, where maybe DM, developed market sovereign debt, starts to behave differently in a downturn in certain places?
If that's the case, it hasn't happened yet. And that's the reason why some people are getting comfort from that rally in the Treasury market. That is where the leverage is at. But the question that you asked, the question that Bob asked to me, was really the crucial question. Where are the fragile nodes in this system that could break? Some people are talking about developed markets, sovereign debt. Other people talking about private credit markets, the outgrowth of markets that haven't really been tested. Where do you, I'll turn that question back to you, where do you see the nodes of fragility should this continue?
Well, I think Nouriel and I saw it in the same place, which is the cost of funding to corporate America. If that's going up a lot at a time when top line will likely come off and input costs go up, that's a very challenging place for corporate America to be. I'm not particularly concerned about the emerging markets. We have to remember that these are different emerging markets than during the Brady era when we introduced Brady bonds. Back then, emerging economies largely financed themselves through hard currency. Since then, over the last 30-odd years, they've built very impressive domestic yield curves. They're supported by local pension funds and insurance companies. Those bond markets are performing well. Emerging markets can survive this.
If the US is going to put up the walls and we see a disinflationary shock for the rest of the world off the back of Chinese overcapacity, that gives them the space to reduce interest rates, tremendously rate-sensitive economies. You'd think that maybe that might help them, Lisa, in the months to come, in certain respects.
Which is the reason why when you take a look at different notes, people are looking at, say, Latin American countries as possible winners, even though they are emerging markets, developing markets that have typically done more poorly. But to your point, it might not be treasuries that bear the brunt of it, but maybe U.S. corporations, if the response mechanisms are not the same in the U.S. that they are, say, in the developing world, where they do have the capacity to cut rates and have gotten the fiscal balance sheet in order.
I think we've all been humbled by the pandemic. You've got to be tremendously open-minded about the situation we're in, that it can break in two directions, cuts both ways. Could be bad, could be terrible, could be great, could be good. I don't know, but right now, the market's having its vote. Equity futures down 4% on the S&P. We're down across the board. Bob, I heard the year 2008 for the first time this evening, and it came from Nouriel Roubini. Maybe some people won't be surprised by that. Are we in a much better position now than we were back then to absorb these kind of shocks?
I think so. I think when you look back at that period, there was a lot of systemic leverage across the system. And more importantly, it had invaded a lot of the banking system globally. So there was a material amount of unwind and the need for a backstop buyer, hence TARP and all the other sorts of policies that have since come out of that. We don't see that degree of leverage in the banking system currently. This looks to be something closer to, I dare say it, a normal recession if we go with Mike Ferroli. I know there is no such thing as a normal recession. They're still incredibly painful, and we need to be sensitive to that. But I think a major crisis, it just doesn't look like that's in the making for now.
Equity futures this evening, a lot of heavy lifting from the words for now. Equity futures down by 4% on the S&P 500. Up next on the program, final thoughts heading into a brand new trading week. Live from New York, you're watching Bloomberg Surveillance.
I prided myself, probably wrongly, having worked in many countries, been brought up as a child in the Middle East and in the Far East, having a mother who was not British, she was Hungarian, she was a survivor from Auschwitz, and I was the son of a Holocaust survivor, and being involved with lots of people, I thought to myself, I know a lot about diversity. And I know about inclusion and not being included. But actually, when I came out, I realized that my level of understanding was not very high. And actually, I could see both the support and the rejection of being different, and what you had to do to live a life where you were different. And I'm immensely pleased that I was outed when I was 60, just under 60. Because had I not been outed, I probably would have said I could stay in the closet and still believe that I knew everything, which I didn't. And that was a very important moment for me.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
In case you missed it, on Bloomberg Open Interest.
Finding some sense in these crazy markets.
I hope they turn around, though. You know, because my 401k, I'm looking at my 401, my retirement, and I'm thinking, God, how many more decades do I have to work?
Your retirement account. I cannot say that enough. Set it and
you need to find a new target date.
I need to find maybe a new future. I'll be standing next to Paul Sweeney as a greeter at Walmart, you know, in our 70s. And
don't miss Open Interest live weekdays.
Live from New York City this evening. Welcome to the program. It's going to be a very, very long trading week. Equity futures down across the board here. We're negative 4.5%. We're down 5 on the Nasdaq, down by more than that on the Russell. Let's cross over to Danny for more. Hey, Danny.
Hey, John. It is a feeling that any risky asset is selling off this morning, and commodities are taking a hard hit this evening, rather, getting my day confused. Brent crude down more than 3.4% after not just the recessionary fears, but the Saudis also downgrading, cutting their level 4 more oil too, so that's taking a big impact. I'd point to copper down here too, down 6%. This is such a change in fortune for this bellwether metal that not that long ago we were talking about shrinking supplies, meaning that this asset should rally. Again, it's something that looks a little bit more like a recessionary fear. So the weird one in all of this is the fact that gold is also selling off. It is down 1%, the spot price. Maybe that points to more of a panicky kind of trade where everything is hard hit this morning. But there is one haven of choice this evening, I should say, that people are buying into, and that is treasuries. The cash market is not open. It won't open until about 8 p.m., but the future is trading. You can see the level that it's at this moment would imply about a 14 basis point drop in yield. So if this thing sticks, Monday will be another big day for this bond market, John.
Danny, thank you. Great work this evening. Catch Danny Berger tomorrow morning, 5 a.m. Eastern Time, to kick off your morning stateside as we approach the first full day of trading. Here's your trading calendar. Your diary looks like this. On Monday, EU trade ministers are meeting and President Trump will hold a news conference with Israel's Prime Minister at 2:30 Eastern Time, so look out for that. On Wednesday, we're looking for reciprocal tariffs to kick in. On Thursday, another round of jobless claims plus CPI data. On Friday, PPI and UMich sentiment plus bank earnings kicking off. We'll get numbers from JPMorgan, Wells Fargo and Morgan Stanley. Bob Michele at JPMorgan Asset Management still with us around the table. Bob, for some final thoughts, sir. Approaching a brand new week, how are you and the team gearing up? How do you approach this moment?
Well, I think you deal with the present. You look at where the markets are, you look at your portfolios and make sure that they can last through a cycle, and you've positioned for some of this. I feel we're in good shape. You watch the development of the news. I think two very important things are going to happen in the coming week. One is financial conditions have tightened a lot. So that's a bit different than when we last heard Powell, only though it was a couple days ago. So now he's got to address that. The good news is, you should add to the calendar, we have about half a dozen Fed speakers next week. So they're going to be out there. These are the people that you need to ask these questions to. How do they weigh this? How do they evaluate financial conditions? Are they really going to sit on the sidelines because of a one-time price change and let the economy crash into recession? Let's see what they say.
Is any economic data completely obsolete and irrelevant to this moment?
It's becoming more irrelevant as the minutes pass. I think it told us the economy was in okay shape going into this. Maybe it's Jay Powell's fault after all. Maybe he created the idyllic soft landing. It enabled the administration to be tough on tariffs. I don't know. But when you look at this, the U.S. economy was doing okay, but there were some signs of a little bit of softening. When you saw the quits rate and the hiring rate start to slow down, it looked like the economy was fatiguing a bit, and maybe that would have given the Fed a chance to come in and cut rates a couple more times. All of that has changed.
High yield worries them, credit worries them. If I think back to 2018 when we saw an aggressive widening in high yield yields, what we also saw on the supply side was that. Zero, no issuance that month in December 2018. I think that unnerved the Federal Reserve. What would you expect from the supply side, from credit, for the weeks to come? And do you think that would be sufficient to unnerve this Federal Reserve if we started to see credit freeze up?
Yeah, I think supply has to pull back. The good news is, for the first 3 months of the year, we saw a very hefty supply. So a lot of businesses got their funding out of the way. They can wait it out. I don't know that this week will tell us anything, but I think as we get to the second half of April, if we don't see businesses being able to finance themselves, then the Fed will be really, really worried. I can't see, if this market continues, that the market will be receptive to new issuance.
It's one to watch, Bob. Appreciate your time this evening. Thank you, sir.
Thanks for having me.
Looking forward to being on this journey with you. Bob Michele there of JPMorgan Asset Management. Equity futures here, Lisa, down across the board.
One thing that really keeps sticking out in my head, a Goldman Sachs partner came out, trading specialist John Flood, right after April 2nd, and he said, I worry that post-April 2nd, it will be very difficult to put the toothpaste back in the tube, even if and when we see positive developments on the negotiation front. This evening, that seems to be what we're waking up to.
We're struggling with that right now. Equities are down across the board. Coming up tomorrow on Bloomberg Surveillance, Chris Verona-Strategas, Dan Skelly of Morgan Stanley, former senior Trump trade advisor Kellyanne Shaw, Lori Calvasina of RBC. And up next on Bloomberg TV, the Asia Trade with Sherry Arn and Heidi Stroud-Watts. Live from New York City, that does it for us. A major tariff push from the President of the United States with a big objective in mind. The journey is going to be a bumpy one. The destination, unknown. From New York, good evening.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April